Whether you are a property owner or just the occasional visitor on a beautiful beach, you will pay taxes in Mexico. Some of the taxes are hidden and others are not. The purpose of this discussion is to touch on some of the important taxes levied and paid in Mexico. First, who collects taxes? The SAT, Taxpayer Administration Service, also known as Hacienda, is a federal tax collector. It collects all federal taxes such as income or capital gains tax, the IVA added value tax, tax on cash deposits, and a special tax on production and services. Each state government then has its own taxes such as a 2 to 3% tax on lodgings and tourism. The municipal governments assess and levy taxes on real and personal properties. The IVA tax is a value-added tax which is charged on goods and services. The only exemptions are medicines and food. Often this tax is included in the price of food served in a restaurant and the items purchased in a department or clothing store. The business owner and tax resident is obligated to file a monthly declaration with Hacienda and pay the tax on earnings. Credited against this tax are IVA taxes paid on goods and services required. There is no IVA tax on the sale of vacant land or on the sale of residential dwellings. The tax is levied on all commercial construction when it is sold or transferred at the rate of 16% of the value of construction, regardless of where the property is sold. IVA tax is charged on lodgings, hotel rooms, and furnished homes which are rented. The IVA tax is 16% in the interior of the country and 11% in the border zones, except for the commercial construction, which I mentioned earlier. Property tax is a municipal tax, with assessments on properties generally being made annually. The tax can be paid in 6 installments every 2 months, but probably should be paid in full within the first 2 months of the calendar year to obtain a discount. Rates vary from area to area, but are often far lower than U.S. or Canadian property taxes. The ISR tax, literally the tax on rent, has been described as both an income tax and a capital gains tax. It is complex and a subject of confusion. Any income generated from sources within Mexico is taxable. The rates are variable depending upon the amount of income received. No primary residence is exempt from tax unless the taxpayer has resided in the home for the previous 5 years. Proof of residency is a form of the taxpayer identification number, the RFC, the voter's registration with the property address, bank statements, and utility bills. For those who have sold or transferred a primary residence within the past 5 years and have not declared an exemption previously, an exemption of up to 1,500 UDIs, or approximately 6.5 million Mexican pesos, is available. This applies to nationals and to those foreigners who have established a tax residency in Mexico and make declarations on worldwide income. They must also provide documents that the property being transferred is a primary residence. No exemptions are permitted on the sale of a vacation or a second home or on a rental property. The tax on non-exempted transactions is 30% of the difference between the value declared in the deed and the value of the new sale less allowable deductions, or 25% of the entire amount of the transaction, whichever is less. It is very important when acquiring property to insist upon having the full amount of the sale declared in the deed in order to avoid overpaying taxes upon sale. Enforcement of the ISR tax on transfers is the obligation of the notary public formalizing the transfer. He must enter the seller's name and data on the internet and to check status of prior transfers. What about taxes on rental income? There are 3 ways to calculate tax on rental income. 1. A 30% tax on income less allowable deductions, which include property tax, maintenance, interest on loans for construction expenses, insurance, salaries of employees, and commissions paid to rental agents and property managers. Another is the blind deduction of 35% of total income without deductions, with tax of 35% paid on the remaining amount. And then there is number 3, a 25% tax on the gross income, no deductions. Hacienda is paying more attention to internet advertising and is beginning to inquire into the income of those who are renting their homes. It makes sense to become legal since penalties for non-compliance can be considerable. Methods 1 and 2 require the taxpayer identification number, which can be challenging for a foreigner to obtain. Method 3 does not require residency or official status. And then we have the state hospitality tax, which is charged by hotels and on furnished short-term rentals. Money generated from this tax is used for promotion of tourism in the state and varies from state to state, but is generally 2 or 3% of the per-night cost of lodging. It is important to understand the difference between tax resident and non-resident for tax purposes. The tax resident is the person, citizen or non-citizen, who has acquired his federal tax identification number and who files and declares taxes in Mexico on his worldwide income. Any party receiving income from Mexican sources, such as from rental or from the sale of real properties or from business activities, is required to file. No distinction is made between citizens of Mexico and non-citizens as to tax rates. Tax authorities in the United States, Canada, and Mexico are working together to share information. Every day there is more cooperation between the countries due to the tax treaties. It is no longer possible to own a property in one country, enjoy income from that property, and not report it in both the country where the property is located and the country where the owner has tax residency. Failure to comply means the owner is subject to double taxation and heavy penalties when the omission to file and declare is discovered. For further information on this subject and others regarding real estate in Mexico, please contact the Settlement Company. Thank you.